Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss optimizing your primary residence exemption in retirement. Specifically, I'm going to chat about what properties qualify, the specific tax years that can impact your exemption, an example of selling a home or a vacation property, nuances to claiming the primary residence exemption accurately, the one planning tip most Canadians miss, and lastly, as always, a few action items for you to consider. Now, the price of real estate has experienced significant growth over the last decade or so, with now some headwinds bringing costs of homes down slightly in some areas across Canada. For many retirees who have owned their home and, say, a vacation property over the last decade or two, have seen their values swell drastically. And within that swelling of real estate values for Canadians lies a potential tax liability looming in the future. See, typically when you sell a physical asset after it has grown in value, there may be a capital gain attached that will attract the taxman. With that, we Canadians who own property that we utilize ourselves have the potential to eliminate some or all of that tax when we sell our personal property. However, if you have two or more personal properties, then determining how to best apply this exemption can be tricky. Now, the primary residence exemption is one of the very few tax exemptions that is available to help reduce your taxable gains liability. And with that, how you choose to exercise this exemption is crucial to understand. Not only for you and your family's situation, but also in the event if you find yourself being an executor of a will where multiple properties were owned by the deceased. In its simplest terms, the primary residence exemption allows Canadians to shelter the capital gains tax on a property that is, quote, ordinarily inhabited. The term ordinarily inhabited does not necessarily mean that you have to live in the property each day, which means a vacation property like a lake cottage or ski chalet could be designated as a primary residence so long as you use it on a regular basis each year. One question I get asked from time to time is whether a husband and wife can each claim a property as a primary residence. And the answer is no. A family unit, defined as an individual along with their spouse, common law partner, and children under 18, can only designate one principal residence in any 1 year. So if you own one or more properties that you use for personal purposes, so not a rental property, you have the ability to minimize taxes by choosing which property to claim the exemption. If you are the executor of a will and the deceased had a home and a vacation property, the same logic applies, although you will need to have a good understanding of whether or not they have bought or sold real estate properties in the past and utilize the primary residence exemption. So, I think the best way to understand this concept is to go through an example. There are also a few little known caveats that impact individuals who have owned properties prior to 1972, prior to 1982, and prior to 1992. In my example, I will assume these properties are held after these dates, so after 1992. At the end of the example, I will discuss the nuances of properties held around these specific years, along with some other crucial planning points that you should be aware of. So, in my example, let's assume you purchased a family home in 1997 for $200,000, and then you purchased a vacation property 10 years later in 2007 for another $200,000. Fast forward to 2026, and you and your spouse have decided to sell both properties in the same year and downsize to a smaller home. When the dust settles from the property sales, you received $1 million for your home and $1.2 million for your vacation property. When we analyze the home you purchased for $200,000 in 1997, we calculate your capital gain to be $800,000, or approximately $27,000 in capital gain per year while owned. The actual number per year is slightly less, but we will use this number for illustration purposes. When we do the same math on the vacation property you purchased in 2007 and sold for $1.2 million in 2006, we calculate a $1 million capital gain, or a $50,000 capital gain per year while owned. That said, because you purchased your home in 1997 and the vacation property in 2007, you will be able to still partially claim the exemption on your home. So let's chat about the numbers. You would designate the vacation property as the primary residence for each year from 2008 to 2006. The year 2007, when you purchased the property, can be saved for the family home because there is a +1 in the numerator of the calculation. Therefore, the portion of the capital gain that is exempt is calculated as follows: 19 years owned +1 divided by 20 years total multiplied by the $1 million gain. Or in English, 100% of the capital gain on the vacation property is exempt from tax. Now, because we know the capital gain per year on the vacation property is $50,000 and on the home it is $27,000, you would only claim the primary residence exemption on the years where the home was the only property owned. Now, although both properties were owned in 2007, designating the family home in that year will not impact the calculation of the vacation property due to the +1 rule in the numerator of the calculation. So that would be 11 years is your primary, +1 divided by 30 years of owning the home, multiplied by the $800,000 capital gain. This equates out to $320,000 being exempt from capital gains tax. Therefore, $480,000 of the capital gain on the sale of the house is not exempt. In this example, I'm assuming that they are joint owners with the right of survivorship. So in turn, the end result would equate out to $120,000 of taxable income to each spouse. Now, I know this could be a bit tricky to follow along listening to a podcast and not seeing the numbers in front of you. So thank you for following along the best that you can. I think the key takeaway here is that when you're disposing of properties, it is crucial to speak with a tax accountant to ensure the minimum amount of tax is being paid and that the primary residence exemption is being properly applied. Now, there are a number of ways this calculation can become even more complicated, which I alluded to earlier in the podcast. Specifically the dates 1972, 1982, and 1992. So let's chat about those. But I'm also going to chat briefly about the impact of rental properties, residency, and the importance of tracking capital expenditures. So prior to 1972, capital gains were not taxable. So if you owned a property prior to December 31st, 1972, calculating the adjusted cost base can be very difficult. You will absolutely want to speak with a tax professional if this is the case for yourself or an estate where you find yourself being the executor. Next, prior to 1982, it was possible for families to designate two properties as principal residences, and it may still be possible to designate both properties for those years. If each property was owned in a sole name of each spouse. If the properties were owned jointly, this may not be possible unless each spouse gifts their interest in one property to the other. Next, prior to 1992, it was possible to shelter capital gains on any type of property using the $100,000 lifetime capital gains exemption. Many property owners had their properties appraised at this time in order to shelter all or some of the gain. If you took advantage of this, your adjusted cost base may be significantly more than what you paid for the property, but you will want to ensure you have documentation related to the claiming of this exemption. If the property was used as a rental property for a period of time, the calculation may be impacted by the value of the property on the date at which the property became personal use. In this scenario, I would again encourage you to speak with a tax accountant. Next, I've mentioned the +1 part of the equation. That said, this exemption is only available for taxpayers who are resident in Canada during the year in which they acquired the property. Lastly, if you've been making improvements to either your home or your vacation property, ensure that you're keeping records of these capital improvements. These are improvements that may increase the cost base of your property, resulting in a potentially lower tax bill in the future. This is a tip that is often missed by families. They add an addition to their lake house, they upgrade the kitchen in their home, but proper documentation is not kept. And when the time comes to now calculate how to allocate the primary residence exemption, having accurate numbers and knowing your adjusted cost base can have a significant impact on the amount of tax you will pay. Taking all of these nuanced steps further, proper records and tracking of your capital improvements will also help your executor settle the estate and minimize the amount of tax paid with the help of a tax professional who can help properly apply the primary residence exemption to your estate. Okay, so that'll do it for today. Here are your action items for today's episode. First off, if you own 2 or more personal use properties, be sure that you're tracking capital improvements. Not sure what qualifies as a capital improvement? On the CRA website, it states renovations and expenses that extend the useful life of your property or improve it beyond its original condition. So, have you redone your kitchen, put vinyl siding on your house? Be sure you're tracking these expenses for both your home and vacation property to ensure you can minimize tax in the future. Next, are you the executor of a will? Perhaps for an elderly parent or friend? It's worth having the conversation now while they're living. You may be able to track down details regarding capital expenditures that will help out in the long run. There is a chance they may have taken advantage of the lifetime gains exemption that was available before 1992 specifically. Lastly, please seek professional guidance. We can help narrow down strategies and timelines to help you make these decisions, but we strongly recommend speaking with a tax accountant when it comes time to file your personal return after a property has been sold. Okay, that'll do it for today's episode. Be sure you're adding us to all your socials, LinkedIn and Facebook. Be sure that you're subscribed to the podcast. Leave us a 5-star review. Make sure that you're signed up for our weekly Retiring Canada newsletter. And hey, when it comes to retirement, don't take chances. make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.